And you hear a lot about our firm today, and you probably have heard a lot about us in the past, but maybe haven't seen us really as an asset manager. So today you're going to learn a little bit about what's going on in the real asset space, and really what we're doing in that space. And with that, turn it over to Adam.
Okay, Jeff. Well, thank you. And thank you for everybody making the time to come on out. I'm glad there's so many of you that did make it. This is my first time here in Washington, and Seattle specifically, so I'm kind of enjoying my time here. It's a nice change up from flatlands of Chicago. And one, it's a pretty decent body of water, but it's not this. So I like the mountains as well. But thank you very much. Yeah, and so what I think we'll do today is we'll take you through a couple things. But for those of you who may know us, you know that TI-CREF is in the pension space, a not-for-profit entity that serves not-for-profit entities. We've been around for a long time, and we'll talk a little bit more in a few moments about our history and what has brought us into the space of real assets. So we will catch up on that in a moment, but certainly it is a vital part of our portfolio. And, you know, we're not alone in that. There's a lot of other institutions today that are chasing real assets. They're trying to identify just exactly how they fit in their portfolios. Individual investors, obviously the same. It's just that the profiles tend to be a little bit different with respect to what vehicles might be available to them to suit their needs. And the reason for that is that there's some very, very strong fundamentals kind of underlying real assets when you invest within them. So we will take a little bit of time to talk just specifically about the supply and demand profile for real assets broadly. Most of my comments today are going to be directed more towards the natural resources and infrastructure space as opposed to commercial real estate, but I'll pepper in a few comments about the real estate aspect as well. So with that, I think we can kind of go ahead and dig in. TI-CREF, I should have brought, a prize of some sort, at a minimum a candy bar, but can anybody tell me what TIAA-CREF stands for? I always like to take this. Yes.
Teachers Insurance Annuity Association.
Yeah, we got half of it. Okay. Now you got the CREF part.
College Retirement Education Fund?
Close. College. So we got kind of a tandem here. Teachers Insurance and Annuity Association. This is the longest financial services name in the history of the planet. Teachers Insurance and Annuity Association College Retirement Equities Fund. Yeah, and so technically speaking, it's two different entities that are tied together. TIAA is the insurance company. It's the longer dated of the two. And then CREF is the investment company under which there are more sort of some of the publicly available investments, stock, bond vehicles, et cetera, that are distributed out to our pensioners. And so I think one of the more relevant things that I can bring you today is to kind of relate our experience as an investor in the category, because you'll hear me say this again, there is no single prescription in terms of how to approach real assets in your portfolio. Everybody's different. Every institution's different. Every individual's different. And because often the structures and the types are esoteric, they involve staff and research. There's different preferences for duration, risk, return, liquidity. I think simply relating for you the background of why we covet these assets, explaining to you a little bit more about our investment profile, that might be more enlightening than me just simply trying to prescribe for you the magical approach to what would work for everyone, which doesn't exist. But TIAA, our history goes back almost 100 years. We were founded back in 1918 by the Andrew Carnegie Foundation, a $1 million grant from the foundation to establish a portable pension system for folks in higher education. And you go back in time, and basically it was this. You had professors who were teaching. They would go from Harvard, then teach later in their careers at Yale, and then they would move over to Princeton, just as they do today. But they would never accumulate a significant pension in any one of those places, leaving them at the point of retirement. I have no idea when 1918 when you would retire. I don't know, 60? Your lifespan was significantly less than it is today. But when it did come time for retirement, they were basically destitute. And so Carnegie found this to be somewhat of a travesty and founded TIAA to be a portable system that would be contributed to, basically think of it as a precursor to the 401k plan, contributed to by the employer and by the employee, and carried with them from Harvard to Yale to Princeton so that when they do retire at age 60 or whatever it is, they have their accumulation that is sizable. And then TIAA, the important distinction of us being an insurance company and an investment company, is the insurance company could then backstop an annuity payment that's going to go on as long as they live. Basically think of it like their own defined benefit program, essentially. So that was the initial vehicle that was sort of the inception of TIAA, a guaranteed option that somebody would contribute to, meaning that there's no market risk to this. It's a portfolio that's backed by our general account that invests in a bunch of bonds with long durations to back up the requirements, the obligations, the liabilities that we have, which are all these pensioners contributing to this very, very conservative vehicle. And so the general account of TIAA has an appetite for, think about asset liability matching, has an appetite to match the duration of those long-dated liabilities with long-dated assets that are very predictable and can kick off cash flow. And so that's the profile of what we need in the general account. Now, fast forward to the 50s, we started to diversify a little bit more. We entered into the direct real estate space. We were amongst the first to start making direct loans to businesses and owning the equity in commercial real estate. And we've grown that portfolio now to be one of the largest commercial real estate managers in the country. So we're running, if you consider the debt and the equity, public and private, we're running about $50 billion now in commercial real estate assets. So very sizable. And the reason that we coveted those is because, as you know, when you consider a profile of bonds and you add commercial real estate into that profile, that's beneficial to the portfolio. So back in the 40s, we started to add to the real estate aspect. And then we grew CREF and we started to grow public, other kinds of vehicles for our pensioners. And it wasn't then only until about the last 10 years or so where TIA-CREF actually opened up our doors. We said, you know what, we're running a lot of money. We're running right now about $520 billion. And we've started to make our offerings available outside of our pension system. So actually there's a lot of opportunity for investors to get to our investments today as we're expanding our distribution. So fast forward a bit. You think of the general account. We still actually have a lot of money, and a lot of pensioners rely on a guaranteed vehicle that we offer. And that thing works like this. It's guaranteed principal, guaranteed at least 3% return. So we need to obligate that, and actually we pay out significantly more than that 3% requirement for a lot of the vintages that we support. So we turn to our general account, which today, just so you know, we have $520 billion in assets. About 215 of that is general account assets. And so we continue to think about how can we improve the diversification profile while still keeping into context the liability profile that we're responsible for. So what have we done? We've started to introduce more and more over the past 15 years real assets into the vehicle. It's not just commercial real estate anymore. So in '98, we started investing in timber, something that's near and dear to a lot of your hearts right here in the Pacific Northwest. We have a dedicated timber team. We have a dedicated energy team. We have a dedicated infrastructure team. We have a dedicated agriculture team. And so that is in our what we call our NRI group, our Natural Resources and Infrastructure team. And you can almost think of that as a platform. You have a head on each one of those, but it's a very synergistic sort of relationship where we can bring those together, and we'll kind of illustrate for you kind of how we take advantage of some opportunities that sometimes combine different aspects of, say, infrastructure and timber, as it would be. So we've become a very, very significant player now in some of these spaces. For instance, agriculture, we're running almost $5 billion in agricultural equity. This isn't we're buying stocks in Monsanto and John Deere. This is we're owning soil, and we're owning almond trees, and we're owning apple orchards, and we're owning vineyards, and we're owning row crops in central Illinois, and we'll talk more about this. But we're a very, very significant player in agriculture. In fact, one of the largest, if not the largest, in the country today. And if you look at timber and infrastructure and energy, we're running about $1.5 billion in each of those. So we've grown the scale of that operation. And again, the primary purpose is for us to, we do recognize that they have very beneficial characteristics, which we'll talk about in a minute. We want to own those for the benefit of our general account portfolio. And we also want to continue to increase the scale with which we operate to bring down our overall cost structure, increase the opportunity set that we have around us, and overall enhance value for ourselves and the investment partners that we bring in. Okay. Also, just to mention, we don't just do things on the private side. On the public side, we do have investments in global natural resources that is more of a 40 Act mutual fund that's focused on kind of global natural resources, and then REITs kind of threw that over there into the real estate category. It's a publicly traded real estate, obviously. So that's kind of a quick backdrop. I mentioned that we have our platform that consists of infrastructure, energy, agriculture, and timberland. And we can kind of illustrate this with 3 different circles. Energy, ag, and timber I kind of put together over here simply because there is some relationships that they share. And then infrastructure. And when you think about this on the sort of outside aspect, you have ag with row crops and permanent crops, broadly speaking. Timberlands, different sort of aspects of producing timber, infrastructure, oil and gas. And where you see some of the circles meet in the middle is where you have opportunities or value add, kind of vertical integration. Where infrastructure meets energy, you have pipelines and transmission capabilities there, power generation, et cetera. Where timberland meets infrastructure, you have opportunities for some timber and ag, you have opportunities for vertical integration. So where we like to play, TIAA, we want to minimize risk. We want to really kind of control the most basics. We want the factor of production. So with ag, we want exposure to the dirt, the thing that's actually going to produce the asset, that's going to store the value. So think of what we're coveting as the thing that stores the value, and we want to mitigate as much of the risk as we can. So that's why you'll see with energy, and we'll talk more specifically about what we're doing, we're going to want to own the reserves. Infrastructure, we want to own we don't want development projects. We want to own a mature asset that we can simply collect a revenue stream from. With ag, we want to own the dirt. With timber, we want to own the growth of the tree. Now, within ag, for example, we own, we're I think the 4th or the 5th largest producer of almonds in the country. Huge almond producer. And so because we're so large, we have really good vision into the supply chain there because we're selling into it. And we have to have those nuts that are processed before they're brought and shipped to market. And so we have recognized opportunities there whereby we can secure offtake agreement. So what we did is we purchased a processing facility, Treehouse. It's called Treehouse in California, whereby we now have a production facility to be able to process the significant amount of almonds that we produce so that we know when we produce we're going to have an off-taker for that. And we also know then, because we are such a large producer, owning that facility, we know that we need to maximize our capacity utilization. So we have a nice steady flow of almonds coming into the shop so that we can make sure that we're producing optimally and improving our margins. So there are opportunities for us to take advantage of some of this vertical integration or leverage some of our aspects of kind of intersecting on the ag, timber, infrastructure, and energy side. Another thing that I would say is ag and timberland can kind of intersect a little bit. We recently purchased a greenfield opportunity in Poland to develop biomass with timber. And greenfield meaning previously it had been more or less just simply grazing land for cattle and whatnot, marginally productive. But it could be farmed as well. So we have 2 different angles to analyze that, whether it be purchased for a farm or whether it to be developed with the timber property. And so you have 2 different teams that can kind of analyze that. Energy could come in too, where then we start recognizing who we can sell an offtake agreement to or set up an offtake agreement with for the biomass that we produce on that facility. And we need to have a utility or another manufacturer who's going to be a big energy producer being willing to produce those, buy those pellets that we create from that facility. So our energy team can come in and help analyze that investment to help organize opportunities to set up those offtake agreements. So this is our platform, and it works quite well for us, and we continue to develop the scale. So we talked about the growing demand for real assets. If you take a look at some of the larger institutional investors, you do see continued ascension of institutional investors into the space. A recent NACUBO study in the National Association of College and Universities Business Officers, the recent poll shows that real assets combined between natural resources and private real estate are now about 15% of the overall allocations. And that's growing. Just a couple years ago, that it's grown about a point a year for the last several years. On average, portfolios for real assets are between 5 and 10%, according to JP Morgan, growing up to 25% in the next decade. And if you do look at specifically the natural resources aspect of this NACUBO study, where again, of the 15%, 8 is in natural resources, that's right here. If you look at just where it was 10 years ago, it was at less than 1%, if you can see that. So there's rapid growth, and there's a lot of opportunity here to continue to see that. given some of the, yes, question?
Question. Given that your timber, infrastructure, energy, and agriculture makes up less than 2% of your portfolio.
Right.
Are you behind the curve? Is that what you're saying?
Well, I would say that well, that's a fair point. I wouldn't put us in this same category. As an insurance company, here we're talking about endowments and foundations, which have a very different sort of profile for their assets and liabilities. In fact, I would argue their duration of their assets can even be longer than what ours has to be. We do have to be mindful that there are a lot of our participants who would want their capital potentially sooner. And so we don't have quite the predictability or the foresight that, say, an endowment or a foundation would. But to your point, I think we absolutely have an appetite to continue to grow it. Are we behind the curve? Are we where we would want to be? I think we would have liked to have been a little further along than we are now. But we still have a strong appetite to grow. Yeah. So, some of the fundamental factors that really come into play making investments in real assets so compelling, number one is that, the underlying assets can help ensure capital preservation. They're productive assets. Soil grows corn, it grows grain, trees, vines, things that will produce cash flow and are demanded by, both domestically and internationally, the markets that demand those. Most importantly, though, is kind of the inelasticity of demand as it relates to population growth globally.